Latest read on the mortgage market, just hitting the wires. And Diana Olick joins us now with more. I want to see this shot that we have, whether we... Oh, okay. I love your shots, Diana.
Rainy,
I want to see
fall, dark.
But you're always in that neighborhood that looks like, you know what it looks like? Haddonfield, and Halloween's coming up. But I always say that. Go ahead. What's going on with the mortgage market?
All right, we're not there yet. Soon, Joe. I promise soon we'll have the backdrop. But I'm going to pick it up right where Dom left off. Look, a sharp jump in mortgage interest rates over the past few weeks is taking its toll on mortgage demand. The average rate on the 30-year fixed rose to 3.14% from 3.10. That's for conforming loans with 20% down. And that is the highest level since last July. Now, as a result, refinance demand fell to the lowest level in 3 months, down 10% last week compared with the previous week, and volume was 16% lower than the same week a year ago. Mortgage apps to buy a home also dropped, down 2% for the week and 13% lower than the same week a year ago. It was driven by a drop in conventional loan applications. Now, the average loan size is running very high, and that's because really the activity is all on the higher end of the market, and the higher rates are now cutting into that. Government loans, which are mostly used by lower income borrowers, saw a 1% increase in demand, but they're a much smaller share. Now, rates continued to rise this week, jumping again yesterday after a report on the services sector came out stronger than expected. Rates are now about 25 basis points higher than they were just a few weeks ago, and that's real money on a monthly payment. Back to you guys.
Diana, what do you think the real tipping point is going to be, and whether this reverses itself any time soon? I'm talking about how hot, like residential is. There's no supply, I guess, but there were also a lot of people that were fleeing the cities to vacation spots and outlying areas during the pandemic. As we reopen, and I don't know, New York's going to have a resurgence, I'm sure, and everybody's going to come back. Will that be it? But there's still not going to be any supply.
No, look, there's not a lot of supply still out there. A lot more did come on over the market, but it was definitely not enough to meet demand, especially on the low end of the market, which is where the strongest demand really is. But it's all going to come down to prices. We're up 18, 19, 20% year over year in prices, and it just keeps getting hotter. At some point, affordability kicks in. Prices always follow sales by about 6 months, and we're already seeing sales start to slip more than expected. So you should see prices start to ease up. I'm not saying go down, but at least the gains will shrink a bit, and that'll help some buyers back into the market. But right now, it is incredibly overheated, and when we see mortgage rates rise like we're seeing now, that really cuts into affordability. That's when we see sales pull back, and hopefully prices pull back a little bit.
Shepard Smith here. Thanks for watching CNBC on YouTube.